JP Morgan saying there's going to be 4 rate cuts before the end of the year. There's only 3 more meetings this year.
So do they mean like 4, like as in 4 quarter points? So one of them is going to be a half point? That's how I read that.
That's exactly what they mean.
Welcome to Drunk Real Estate.
Grab a drink and enjoy the show.
Hey there, welcome to episode 107 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and I'm joined by my best buds, Jay, AJ, Mauricio. How's it going, guys? Cheers.
Woo!
Got a lot to talk about this week. A bunch of economic updates that have happened. We talked about jobs last week. A lot of things have trickled down from that jobs report. JP Morgan now sees 4 Fed rate cuts on the horizon the rest of the year, which before it was a lot less than that. We have a 90% chance of a rate cut coming in September. It used to be below 50. We had inflation come out this morning, and that was a surprise. So, Jay, why don't you start us off? What's going on with the economy right now?
Yeah. So, can I start with just a pet peeve of mine? So JP Morgan saying they're going to be.
Are you talking about the top 10? Are you talking about the top 10?
No, that's a pet peeve of yours. All right. JP Morgan saying there's going to be 4 rate cuts before the end of the year. There's only 3 more meetings this year. So
do they mean like 4, like as in 4 quarter points? So one of them is going to be a half point. That's how I read that.
That's exactly what they mean, and I'm just being funny because it's interesting how the terminology has changed. It used to be a rate cut was any amount of rate cut at a particular meeting. Now it's, I think, a rate cut is a quarter point. So yeah, so they're saying that there's going to be a full point cut before the end of the year. The market is agreeing with them. The market's saying that there's a 90% chance of the first cut. I don't know if it's agreeing with them by the end of the year, but the market's saying there's going to be at least a cut in September at the September meeting. And a month ago, that was like 50%. Now it's 90%. And so I think today's inflation report kind of cinched the idea that we're going to see a rate cut in September, which is interesting because if you look at the inflation report, typically speaking, when inflation is low, it's a lot easier to cut because cutting could lead to inflation. When inflation's high, you don't want to cut. And so the headline came out today that inflation looked good, and the headline number did look good. If you looked at just the CPI number, month over month, up 0.2%. So same as last month, 2.7% growth of inflation since last year, which is a good number. If you dig in a little bit, though, it's not as pretty a picture. I mean, it's not horrendously bad, but it definitely doesn't look as good when you dig in. So if you look at that 2.7 number, a lot of it was driven by the fact that energy was down 1.1% last month, and that's a monthly number. 1.1% means down annualized over 12% or over 13%. Gas was down 2.2% last month, which is a big number. It's actually a good thing. I mean, gas prices are now back to where they were at the beginning of the year, so we always want gas to come down. That's
not in California, man. In California, we're still over like $5 a gallon.
Yeah, half of that's tax, though.
Yeah, I was going to say that's a lot of states have extra taxes that they throw on, and that's a state issue. But yeah, gas is down a lot last month. So if you take out energy, you take out that 1.1% drop, you take out food. So that's the other piece that's pretty volatile, can change a lot. And so we have this metric called core inflation. So it's the inflation number minus energy minus food. That one went up a bit. It went up from 2.7% to 2.9% last month and 2.9% to 3.1% this month. And basically, if you dig into core, what you see is things like furniture, appliances, household goods, recreation equipment, footwear, basically anything that you get from Vietnam. China, Vietnam, and India. Those are the big ones that are sold in big box stores. Those went up a good bit. So I think it's clear that at least for certain things, big box stores are starting to pass on costs. Also, cars and trucks were up a good bit last month, 0.5%. And then there's another measure that we don't talk about a lot because normally it falls in line with either the main CPI number or the core number, but that's called super core. And super core is where you're basically just, you strip out energy, you strip out food, just like core, but you also strip out housing and you strip out goods. So it's basically just services that are.
So you just strip out like 2/3 of what everybody spends money on?
Well, that's the funny thing. A lot of what we spend money on in this country is services, and you don't realize it. We talk about the goods portion of things a lot. We don't talk about the services portion of things a lot. But the reason why it's important to sometimes focus on services is because when you measure supercore, when you measure the cost of services up or down, you're basically measuring wage-induced inflation. So you're measuring how much business owners need to charge more because they're paying higher wages. And that's what we see in the service industry. That's the core component of cost to business owners in the service industry. It's wages. And so when we see supercore inflation go up, typically it's because we're seeing wage inflation, or we're seeing businesses that are having trouble finding employees at whatever previous wages were. And so for supercore this month, we saw an increase of 0.5%, so 3.7% year over year. And we saw some major increases in things like airfare, shipping costs, insurance costs, healthcare costs, personal services, things like haircuts. I mean, basically all the services that most of us need in our lives. I mean, maybe we don't need to take plane flights all the time, but we need insurance, we need healthcare, we need these personal services. And so super core inflation was up quite a bit from last month. So when you dig in, again, the headline number wasn't that bad. The headline number basically said things were the same as last month, which is good. Don't get me wrong, that's a good thing. But when you dig in, things weren't quite as good. So given that, you might think, okay, there's a little bit less chance of the Fed cutting at the September meeting, but given that the headline number looked good, given that the jobs data was really soft the last couple months, and it looks like the Fed's going to want to kind of get ahead of that, if it's not too late to get ahead of that, I think the market's saying there's a 90% chance of a cut. I think that's probably pretty reasonable. So I think we're looking at a rate cut, at least a quarter point come September.
You know what's interesting? I was just looking this up because I was out all day, so I just didn't see the news this morning. But what's interesting is that the next Fed meeting is September 16th and 17th. The next CPI reading is September 11th. So 5 days before the meeting, we have the new CPI.
Well, we also have PCE too, right? Like theoretically, when the Fed came out and said like what their preferred inflation gauge, it was core PCE, and that's end of August, right? Like the 29th or something.
Yeah, it's the last Friday of the month.
So technically, we still have a PCE report and a CPI report coming up. I was super surprised because I literally had to go and look for this. Like if you look at headline news, go to any major news site, because I just hit the top 3 right now. None of them are reporting anything about this inflation report.
What a top 3, Mickey Mouse.
Well, so first I go to All Sides, first of all, because that's where I like to get my news for the most part, and it's not even one of the top 10 news things. Then I went to MSNBC because I was like, okay, if anyone's going to be on this inflation report, it's going to be MSNBC, right? And they have nothing about it. And so, like, I guess like this was, to me, I looked at it. This was the quintessential, like you could pick and choose your headline, right? You could either pick, to Jay's point, you could pick headline inflation, be like, hey, we got this under control, everything's good. Or you can pick core inflation, be like, look at the last 3 months, like core inflation's an issue. And I feel like no one's jumping on either side of that, which I don't know, I guess is kind of a good thing for the Fed, right? Like they can, like they don't have to really answer to anyone because of this report. They could just like slowly do their thing.
Yeah, well, keep in mind the other piece is reality versus expectation. If the media and everybody expected that inflation was coming in lower this month, people would be freaking out about this particular report. Everybody expected that inflation was going to come out a lot higher than it did, and so things actually were better than expectations. And so a lot of times when you look at the media is reporting relative to expectations. If this is better than expectations, well, it's hard to find an alarming headline, even if they might want to. And I think at the end of the day, again, if you dig in, and I probably dug a little bit harder than most people, you can find good, you can find bad. But at the end of the day, I think a lot of us were expecting a much worse inflation read, and it wasn't that bad. And so
Wasn't
I
bad
don't.
at all.
Yeah, I don't think. I mean, again, services is a scary. Certainly, like the big box store commodities is not good. But food, I mean, food away from home was up, but food was down, and I think that's amazing. I think nobody expected that, so that was a great thing to see. And so, yeah, there were. It was a lot of good, a lot of bad in this report. And
Jay, was
so,
food down or was the rate of increase lower?
So food was actually, let's see.
So like my eggs were cheaper this month than they were last month.
My eggs were cheaper because my chickens are having more eggs.
That's because your coyote population's going down.
So yeah, negative. Oh no, I'm sorry. Food was zero. So there was no inflation in food this month. Food at home was down. So yeah, food at home was down at 0.1%. So literally
But this
cheaper.
seems to be a reoccurring thing with this inflation. It's like we were told how the economy was going to implode, and they've been screaming, and it just keeps missing. Like it's like miss, miss, miss. It's better and better every single month. And it's so frustrating to listen to the Fed and everybody else be like, oh, we can't do anything because this is happening. And it's not. And we're not getting it. It's not that it won't, but the driver of these excuses are inflation and labor markets.
Well, when you say things are better every month, they're not. They've actually been worse every month.
Not than what we've expected.
Well, and again, that's expectation. That's
We
expectation.
hit that goal basically of we're like basic right at the Fed. And if you take out literally housing, like you're there. So we are, I mean, we are better than anybody thought.
Jay, does Supercore strip housing?
Supercore strips housing, yes.
So it just, once again, it's like there's these excuses. It's not, the economy is not doing horrible. We don't have inflation issues, and we're still doing all of these things in tariffs, yet these are the excuses that keep getting given. And I think everybody's being told, oh, it will come though, but it is guaranteed it's going to come. And we've been told that all year, and it just hasn't ever happened.
Yeah, I still think it's too early to. I mean, we say this almost every week. It's too early to tell any of this stuff. So anyone who acts like they know for sure, there are some indicators that Jay said. Some of these things that come from China, Vietnam, in things like that, we are seeing some inflation, but we also are seeing disinflation or in other things. So it's like maybe this thing could offset, or maybe that's just those are the first things to act. We don't really know. And honestly, as I said, we've already spent more time talking about it right now than the entire media has. I'm like, you asked me which sites. I'm on Fox News right now, and the headlines above inflation, I can't even find it, are the former first daughter ends marriage with social media post. Chiefs legends reveal how Travis Kelce's love life was before Taylor Swift. This is all before the inflation report. So no one's really talking about it.
When 2025 started, inflation has gone down and stayed below 3%. It's gone up a little in the spring, But
well, didn't we just say that core CPI is at 3.1? So once again, you can kind of pick and choose which ones you're looking at.
I'm talking about CPI.
Yeah. So the Fed's always said they care about core, right? But they also would say PCE, which is calculated a little bit different. And we still have yet, that's to your point, that's still below 3 as of right now. It could change at the end of the month. But we still have 2 more reports. So we still have a lot that can happen before the next Fed meeting. But what we care about, obviously, is how this is affecting what the Fed's going to do. And more importantly, expectations going forward, right? Like our interest rates aren't just, most people think interest rates are just the Fed, but more important than what the Fed does is the expectations of what the Fed's going to do after next meeting and how many cuts are going to come after that and the forward curve, as you might say. And so, AJ, I'll throw it back to you. Like, how do you think this is a too big of a whiplash reaction for, as we said, what was it? JP Morgan said 4 cuts, which like, a lot of people were calling for zero. All of a sudden, one jobs report, we're going to 4 cuts, which would obviously be great for us as real estate investors. That means rates are coming down. But is that, do you think that's going to happen? And if it does, like, what's the effect on us as real estate investors?
Well, I mean, I think, kind of like what was already discussed. I think everybody's kind of assuming cuts are happening. JP Morgan has 4. I think they needed labor and inflation. That's what everybody's been waiting on. So, and I mean, inflation, like we talked about, it's nothing, kind of a nothing burger there. And then labor markets have softened and eased. So it was like we talked about last week, it wasn't strong. So I think that they have a path. It's whether they're going to take it or not. But I mean, yeah, kind of like we talked about. Yeah, I think they're going to lower it. And that's what real estate investors need. We need lower interest rates. We need to be able to refinance and buy. And I think JP Morgan's 4 points and everybody else is saying it's just how many cuts, right? I think we're going to be in a new cycle. Oh, like we're in an easing cycle now, not a tightening one.
Yeah, but are you taking? Let me ask you, AJ, is your contention or your position that if the Fed lowers the overnight rate, that's going to lower the 10-year, which is really what affects real estate? Do you think the correlation there is pretty strong? Because if you look at the 10-year over the last, as you guys all know, it's gone down a lot. I think 5 to 10% in the last, 30 days or whatever. It's come down significantly, right? There's been a lot of buying of treasuries over the last, 2-3 weeks. So the question is the Fed just catching up? And, this is the 10 years leading the Fed. The Fed's going to catch up? Or do you think the Fed reducing rates by 25 basis point is going to really move the 10-year?
Well, yeah, because right now we have on the table that basically the Fed isn't going to cut at all. Like, they are inflation bulls, and they believe that, hey, we can't be cutting into this future, versus if they just come out and once they break this dry spell of cuts and do one cut, that kind of eases everyone's mind that, okay, they are willing to cut if they're presented with enough information. And I feel like that will bring it down, but it's also expectations, right? There's already a 90% expectation of a cut. So if they actually do cut, it's not going to change anything.
How is that going to affect the 10-year? That's the real question.
Well, that's what I'm saying. There's a 90% chance right now, expectations. The market is expecting a 90% chance of a cut.
Of the Fed's overnight rate, right? So that's a short term. What does that have to do with the 10-year?
Because if they just keep with what the expectations are, the 90%, and they cut, the 10-year is going to be barely affected at all, because that's the market expectations, is that they cut. What would affect the 10 years if they came out and they went against what the expectations of the market, or even if the market expectations came down in that, somewhere in the 40 to 60% range, then you'll see bigger swings based off of what the Fed does. But if we're getting into 90+% chance, a Fed cut doesn't change the 10-year at all.
I just don't think, and that's why I didn't want to take it away from me. I was just questioning, just kind of as a discussion point. I'm questioning whether the 10-year is affected by the Fed cut rate, because a lot of people argue, and I'm one of them, that it doesn't. That there's, first of all, the 10-year Treasury market is one of the deepest global markets around. And I've actually seen graphs where if you look at the Fed funds cut rate going up and down, it doesn't strongly correlate with the 10-year. And
not the short term. The short term, no, but the long term, yes.
And the reason for it is that it's the same pressures on the thing that actually controls the 10-year or the other expiration dates in bonds as drives the Fed to increase or cut rates. When the economy gets soft, the Fed's going to decrease rates. Well, when the economy gets soft, investors are going to move money out of the stock market into bonds, which is going to drive yields down. And so it's not necessarily.
Is that the Fed lowering it, or is the economy being soft lowering it?
Exactly. It's the economy being soft. The economy being soft gets the Fed to lower their rate. The economy being soft gets the other rates to go down. And so they both go down, and it feels like the Fed's controlling it. But the reality is, and a lot of economists would argue this, and I don't know, I've never done the regression analysis to see if it's causation or correlation, but a lot of economists would argue that the Fed doesn't control the longer end. It just so happens the longer end of the curve, the 10-year and the Fed are both being controlled by the same thing, inflation and the economy.
Right. But there is, like, if you go and look back, and if you ever look at drastic swings in the expectations of rate cuts, so we just saw one, obviously. It was only like it was right around, it was bouncing back between 40 and 6, but it was basically a coin flip for September before that jobs report. And all of a sudden, the jobs report comes out, the expectation for a cut goes from coin flip to 90% chance. And what happens? The 10-year treasury goes down by 20 bips or whatever it was. And if you look back to any major movement in the expectations for rate cuts, then that has major movements in the 10-year treasury. So like you could say, okay, they don't affect each other, but at the same time, the expectations for the rate cuts is what affects it. So in essence,
but they're both reacting to the same thing. They're both reacting to a supposedly bad jobs report, which means we have a weakening economy, and that's what's really moving the 10-year, not the Fed expectation of what the Fed's going to do. It's like the economy is not doing great. Jobs, again, it's just one report, but if suddenly the economy is just not doing great, then that's part of the reason why the 10-year moves. Part of the reason
it went to 90% because investors were reacting a certain way to other news. And so it's not that the 10-year dropped because it moved to 90%. The same thing that moved the 10-year down 20 bips and moved the likelihood of a rate cut up was the same.
fair. So AJ, do we believe him? Do we think that's coming?
Yeah, I think pretty much like cover. How many sources? I think it's a market consensus right now. I think it's going to happen. I think it needs to happen.
Is it going to be too little too late, I guess, is the thing, because there's been this feeling in commercial real estate that there's a lot of people been hanging on, right? They've been saying, okay, if we just hang on till we see these rate cuts, until when they start cutting rates again, everything's going to be fine. And back in 2024 it was the survive to 25, and what was Mauricio's version of this, persist to 26 or whatever. Are we actually, has it come? The persist to 26 is good. If you have made it this far, you're going to be fine.
It's going to be heaven in 27.
Yeah. I think the first of all, I think delinquencies are up. They're way up. There's only so long that people could put it off. And that is usually the end of that is a key indicator of an end of a cyclical cycle. It's the finally people letting go, like the hope's gone, they're dropping off. So we've seen large defaults that can't just keep bleeding. And that's what's starting to happen. And the Fed reversing course, right? That's the start. But it's not the end of the defaults necessarily, because they don't just drop rates and it goes down to where they need it. What generally happens is, we move through. So as the capital shifts, as interest rates come down, you still have to entice buyers to the market, but you're still having the problem with defaults is changing comps. It changes the way that banks loan money. So it takes time, but it is almost always the defaults are the start of the new cycle. It's just a lagger. And so I think that that's going to persist within it. I think we're going to see the defaults as they've really gone up. And I think that will continue to happen through the rest of the year. But next year and on, I think JP Morgan and lots of other people, that Fed's now going to move into more of an easing, but it's not going to be dramatic. It won't, not as long as the economy is doing as good as it is, it can't be dramatic. You can't, inflation isn't a problem right now, but that's because interest rates are sky high. So, they will begin to ease. How much they do, right? That's the question. So they're going to be late probably to the party because they're not going to ease it enough, I think, to stop a lot of damage. That still has to come. The job numbers was helpful for us, showing the reality of the situation in the job market. That's, once again, one of those key indicators. But for real estate investors, you got to remember a lot of this stuff, it doesn't even correlate. So what the Fed is doing and trying to manage, they're not thinking about you and your property and how it's better to have a lower interest rate. They don't care. That's not even for the most part a systemic issue. They'll let real estate developers and operators default to avoid inflation and crushing Main Street. That's just how it works. So they're going to walk easily into it. Even if they do 4 cuts from where we're at, that's not going to change most of the problems. The resetting of value that won't happen till we get deeper into it, which will probably be 12 months. And then markets will start to adjust further. But you're going to have to, some of the stuff's got to go out. Defaults will probably continue, or we'll see more job or properties on the market have gone up. People are trying to sell. Capital's moving. They're walking away from equity now, which had stalled out for basically 2 years. Once again, the wealth transfer has begun. That's a good sign. And as that stuff flushes out. So yes, but it's not fast. But yes, the news cycle, I believe, has completely begun. We are putting in 15 plus million of our own capital along with investors. In the next 6 months, we're buying everything we can. Everything.
And just to clarify for everybody that's listening, I assume when you're talking about you think defaults are going to pick up, you're talking about the single family market because you're not talking about multifamily or self-storage.
I'm talking commercial. Yeah, I am talking about commercial.
You are talking commercial. Okay.
Yeah, commercial markets right now, defaults are at, so if we looked at the CMBS market of delinquency rates, they're up to 7%. They were below 5. They were down to like almost 4 in 24.
To be clear, commercial, we're talking office, warehouse, retail, multifamily, all of it, right? It's not
all of it.
July 2024 overall delinquency rate of all commercial CMBS, which is a big distinction if you are in the multifamily space, but this is CMBS was 5.43 1 year ago and is now 7.23.
It's huge moves up.
And we're seeing that in the trenches, by the way, right? We're seeing that. We're like we all have our own anecdotal evidence of people we know.
Well, yes and no. Multifamily, I feel like, has to be taken a little bit separate from these other aspects, just because such a large portion of these loans are Fannie and Freddie loans, and at its peak, Fannie and Freddie had like 85% of the loan market. That's come down quite a bit. It's tough for me to find exact numbers, but it's still in the, I think, 70% range, 60 something range of all loans are Fannie and Freddie. And if you look at the Fannie and Freddie delinquency rate, we're still like 0.5%, like less than 1% for Fannie and Freddie. By the nature of those loans as well, like they're obviously better loans than you're getting on the CMBS markets.
But if you March to July for multifamily, delinquency rates went from 5.4 to 2.
Yeah, and so I dove into that a little bit, and if you look back, that can kind of be I don't want to say brushed off, but that can kind of be attributed to seasonal, like just the way these loans are, that the delinquency rate
are those Kyle Wilson seasonally adjusted numbers?
Well, I read enough articles that said that it's like if you look at like still 8 of the top 10.
Okay, but don't look at it seasonally, year to year, right? So if you look just like year to year where it's up, I mean, springtime low, but I mean, they're still definitely moving up. You have a 24 basis point increase. I think that all commercial real estate delinquencies are going up, and it's that's I think obviously some are much higher. So if you looked at office or others, they're much higher, right, than the average, but they're all going up.
But keep in mind, I mean, when we look at the single family market, a softening in the economy overall is likely to lead to a higher default rate. I'm not talking historically. I'm not talking about today specifically, but in general, softening in the economy is going to lead to a higher default rate because people are losing their jobs and people are having to move to other places for jobs and they have trouble paying their mortgage. In the commercial space, and when I say commercial, I should say in the multifamily space, because I don't want to speak for other asset classes I'm not as familiar with, but in the multifamily space, there's some amount of economic pain that is actually good for multifamily investors. If there's enough pain that we see rates drop without seeing vacancies spike, without seeing rents drop, without seeing other bad things happen on the income side, if we see rates drop to the point where we can refinance, we can originate new loans at lower rates, we can basically cut our expenses. And again, with unless there's something major that happens, we're probably not going to get hit too hard on the income side. So a softening economy can actually be good for multifamily to a degree. Also, keep in mind that for all commercial real estate, the value of that real estate is going to be based on a cap rate. And cap rates have a relationship with the federal funds rate. There's going to be a delta between what somebody can get in the bond market and what somebody's going to be willing to invest in.
Yeah, but that's not the. Let's just clarify. That's not the Fed funds rate. That's the bond market and the Fed funds rate.
Right. Sorry, you're right, and that's 100% right. And so when I say rates coming down, I'm talking about the softening economy that leads rates down, not just the Fed arbitrarily lowering rates. But if the economy softens and rates come down, we're going to see cap rates likely come down some. Which
I would say right now multifamily is probably most tied to the 10-year. Just or those longer end, maybe 7-year, just because what I'm seeing in the market right now, there's very few people who are getting these bridge loans, right? Like fool me once kind of thing. Like no one really wants those like high priced bridge loans right now. Everyone's trying to make the numbers work on these fixed rates, these longer term ones, and those ones are tied to those longer treasuries versus if you were getting some sort of bridge loan, those are tied to almost directly tied to the Fed funds rate and the SOFR curve going forward. So I just wanted to, I didn't want to derail.
But what's that orange? What's that orange line?
Industrial.
What's included in industrial?
Storage, warehouse,
storage,
self-storage.
What was their delinquency rate on the CMBS markets?
Well, yeah, AJ, I don't know if you should be taking credit for that. I think that's a lot of the large industrial warehouse type.
I don't take credit for it.
Yeah.
I don't know. How do I control if people default or not?
And I know a lot of those, like, especially those like marijuana growers and stuff, like they're paying their year in advance. You know what I mean? Like it's tough for them to go delinquent on these things when they're paying a year in advance.
Here's an important thing to keep in mind with this chart. For those, I'm sorry, I probably should let you say it, Kyle, because I know you've been waiting. But Kyle put up a chart of delinquency rates for anybody that's watching on YouTube of different asset classes. It's worth mentioning here that multifamily is going to be a good bit different than all these other asset classes in the sense that leverage or the total debt to price ratio is going to be much higher in multifamily. Oftentimes we get loans for 65, 70, 75, even 80% of the value. And so it's a lot easier in theory for multifamily to become delinquent because values only have to drop 10 or 20 or 30% before our properties are underwater. AJ, what's typical in the self-storage market? What's typical
30.
for 30%? In the office space, I think I once heard the number like 42% is the average. And so for office to be all the way at the top, delinquency like way above all the other asset classes, that's scary because those properties are like 40% loan to value that barely leveraged. And so just keep in mind that not all asset classes are created equal when it comes to delinquency rate, because leverage ratios are going to be a good bit different between asset classes.
I've been surprised by lodging.
We did discuss this before, though. I also think that's lodging, malls. I think they were on a different cycle where, like, like COVID and other things, like they kind of put them on a different like path than the rest of commercial, where like they really bottomed at a different time than the rest of these asset classes.
I completely
and,
agree.
And I'll go pull a different chart. I always reference, so I like TREP for their loan data, but then I like Green Street actually for their value of assets. So while we talk, I'll go and pull that one. But if you look at like where the peaks and troughs are, like you could see that those are two asset classes that are completely different than multifamily, self-storage, industrial, those things like that.
There's an interesting observation I've been making, and in preparation for this, I pulled up all the different schools of economic thought, like whether they're Keynesians or Austrians or traditionalists or monetarists. They all have different explanations of what it means that interest rates are going down. Because what I found fascinating is a lot of people are saying, well, interest rates are going down, which is going to be great for real estate. Like now it's going to be like, oh, the boom's going or whatever. And none of the schools that I was looking at, like how they all have different explanations to why interest rates are going down. Some say, look, it's inflation and growth expectations. So if interest rates are going down, that means people are expecting inflation to be lower and growth to be lower, which is not a good thing because they're buying the bonds and all that stuff. And other people say different reasons, but none of them say that it's a good thing. And so I find it fascinating that when people are arguing interest rates are coming down, so this is a great time to buy, it's like saying, hey, the good news is my property taxes, we talked about this a couple of weeks ago, the property taxes are down. It's like, yeah, they're down because your properties are lower. So it's like, it's good news within the overall bad news. So the fact that we have lower interest rates, if that means the economy is softening and we're going into some kind of a recession, even if you're getting a better deal in terms of a better loan for your real estate, does that really mean it's a good thing? I throw that out to you guys.
It's the 2008 effect. I talk all the time about how after 2008, once we had forgotten about 2008, by the time we got to 2014, 15, 16, everybody was talking about, wow, I wish we had another 2008 event because I would buy everything. But I was around during 2008. You guys were around during 2008. Nobody was buying everything because everybody.
Well, yeah. How long did you have to wait? You probably had to wait till 2010, 11.
You couldn't even get a loan in 2008.
I was buying stuff, but only because I was too stupid to know otherwise. Turns out that it worked out well, but I didn't know that at the time. But yeah, everybody thinks if stuff were on sale half price, I would buy everything, but they don't realize that at the same time, you get out of bed in the morning and you're terrified to walk outside because you don't know what's going on in the world, and you can't get loans because loan is tightening up, and you can't sell property.
Or your rents are weaker, softer, or your occupancy is lower, or maybe not occupancy, but at least your economic vacancy is lower because people have, they're losing their jobs and they can't pay rent, or your delinquencies go up, and it's a nightmare out there.
Yeah. So everybody is wishing for lower rates, but they don't realize that with lower rates, they just assume you can have lower rates, but none of the bad stuff. You can get the good stuff without the bad stuff, and it doesn't work that way.
Right. I mean, does anybody on anybody here think that lower rates is in generally a good thing in the economy, or does everybody associate lower rates with bad things, either a softening?
I mean, theoretically they could be. It's just historically, especially, like, we obviously want a rapid rate decrease, and anytime there's been any kind of rapid rate decrease, it's because of a bad thing happening, right? Like, theoretically, we could just see these rates taper off into that quote unquote neutral rate that no one really knows what it is, but predicted the Fed is kind of implied it's somewhere in the mid threes. So theoretically, we could just see it taper off into those mid threes and then just hold it, and everything's going to be great. But historically, most significant rate decreases have come at the result of something bad happening, and usually that something bad happening is bad for most of commercial real estate.
But this goes back to what we were talking about earlier. It's the economy. I think it can be argued that it's the economy that drives rates. It's not the Fed. And so the Fed could lower rates all they want, but the 10-year and mortgage rates and cap rates aren't coming down unless there's something bad going on in the economy. So I think to Mauricio's point, my take is there's no way to get low rates without the pain that comes along with them.
At least not in the current environment, right? I mean, if we were in a free market place, then rates would come down when there's more.
You could pick and choose, obviously. Like if you go back and look at history of the Fed moves, like there have been Fed moves that were not as a result of something bad happening. Like most recently, just back the last time that Trump yelled at Powell was raising rates, and then he just started backing off, and nothing bad was happening at the time, and that right up until COVID. So like you could pick and choose. There are instances of rates being lower.
That was 2018-19, and we were starting to see a softening in the economy leading up to the pandemic. So
I feel like it was the same as going on right now, where some people were saying it was softening, other people were saying we have a robust economy. Like it just kind of depended who were.
Yeah, but it wasn't clear. It wasn't clear we should be raising or lowering. It wasn't clear the economy was strong or weak. And if anything, I would argue that we could talk all day about whether we think the economy is getting better or getting worse. But rates is going to be the best indicator of that, regardless of what we say or anybody else or the Fed says. Rates themselves are a reflection of the market in general. The broader market,
the longer end,
certainly.
So I'm interested. So AJ, you mentioned that like how much money you were earmarking for investing right now. Are you planning right now, or do you still see additional softening coming and you're just kind of like ready to pounce?
Yes. As in we see softening coming, but we're not waiting. We don't wait. We don't time markets. So the deals are there. We're buying. We've loaded up capital, and we're executing. We're buying as much as we can. So we'll continue to over the next,
with the expectations that like things still could start to come down a little bit, or that.
Yeah, absolutely.
And it's similar in the multifamily. And we just came back. Jay and I were at Limitless. And so I was talking to a lot of operators out there, and the sort of the larger ones, they were all saying, at least in the multifamily space, that this is it. This is the window. You've got 18 to 24 months to load up. Everybody's fearful. It's like uncertainty, but this is, if you know what you're doing, you're buying stuff that's cash flowing, that's below replacement cost. You've got like a 2-year window to go buy this.
It's still so tough because here's the issue.
It's hard to buy when the knife's falling and you want to go. You don't want to catch the falling knife, but this is the time. That's when you start.
Well, this is when you want to be BlackRock, right? Where you could basically you have all that capital and it's trusted capital, and they just kind of like you don't have to really answer to it. Because here's the problem: is even if you have the theory of all of these things happening, and it's going to be the best time to buy, you still have to put together a pro forma and sell it to investors that this is going to be a good investment. And if you start putting any expectations of growth or like any of these outsized things that aren't historically haven't happened into your pro forma, like investors aren't going to invest in your deals. Like
AJ, I'm pretty sure, AJ, you're not promising to double people's money after year one. Like it's like this, you educate your investors, say, look, this is where we are in the cycle, and this is it's a 5 to 7. In 5 years from now, we're all going to be in great shape. Maybe next year it's not great. The year after that's not great. But in 5,
well, no, we don't even invest like that. At the end of the day,
that's right. You have your investments are all ATM machines, right, AJ? You invest in your deals and you just get ATM money.
Exactly. They just spit out money like it's stupid. It's just like crazy. No, we buy deals predicated on yield. So at the end of the day, I don't care what the future market's going to do. I don't care if cap rates are going to go down, because if I can purchase at a yield that is, we can get it to what we call our golden ratio, then we're going to buy. And that is hard to do at certain prices. Right now, we're getting deals that are hitting our golden ratio. And of course, as things soften, we get more deals, and we believe that's happening. But we're getting those deals, that we're getting yields on cost that are amazing. And we believe that obviously will continue, and we'll just keep buying. So if the markets turn around and eventually come back, right, which for us, I care more about occupancy and rates. which we believe that will happen due to the contraction in overall supply. So the biggest thing with high interest rates are it constrains market supply. You can't high cost because of inflation. High interest rates constrains new supply onto the market. There's a 3-year lag. So that is pent up demand. So today's yield, if we can buy a stabilized 10 on cost, tomorrow, without saying market rates are going to go up, what that happens in high demand and high markets, and once again, we did this in 2008, and it was, obviously at those returns, with markets change or when markets change, you get a huge windfall from it, but we don't expect it. We don't underwrite it for it. So as markets go down, and by go down, I mean price of assets that are being sold are sold at lesser and lesser amounts as people are either bailing or ditching. We do not believe there's too much liquidity in the market right now we're not going to see anything crazy. We have $3 trillion in money markets. We have, almost $1 trillion already earmarked for real estate. It's bonkers. And we have BlackRock, others, they're rolling out $1 billion funds at the moment. There's so much liquidity in the market. This is not 2008. You are not going to get assets at fire sales like we did. Why? I'm buying them. I don't need it to give me it for free. I need a 10 yield on cost. And then as markets,
but I assume AJ, and maybe this is just me trying to make excuses for us not being able to buy deals. But I assume because of the nature of your industry, you're still able to find some deals where you can buy them with no competition, right? Whatever your marketing tactics or whatever, how you're finding this isn't like the problem with multifamily is we're competing. If it's an asset in good shape,
you guys operate on margins in competition that is different than we do for a lot of reasons. Ours is operationally hard. And so be able to underwrite, be able to execute like everything from expansions to understand the difference between street market rates. There's not lots of people that are versed in that in the storage industry. You got to remember well over 80% of all syndications and funds in my industry came after 2018. Like you just don't have it. So when we're looking at getting a 10% yield on cost, I'm not talking about a listed deal, even though we've bought listed deal stuff. What I mean is it's not like other markets where it's just, deals are just everybody we go back to 2008 where you could just go buy it. Like you just go on the MLS and buy something that was great, right? That will not, I just don't think that'll happen. As of right now, I haven't seen one deal in 2 years. I mean, not even close, that actually traded what it was listed for. It was listed for $10 million and it sold for $8 million. The last two not development deals, but brand new builds that we bought, both groups walked away from all of the equity, all of it. And so they're walking away from millions that we're now buying, which, a lot of times that was what it cost to build, put into it. They didn't list it on the market for that. We had a deal a month ago I didn't get, which sucks, but it was put on the market for $16 million. We found out from the broker it closed at like $9 million.
So I guess what's the change in cap rate have you seen since the peak to like what you're purchasing things?
Third tier markets, we've seen easily a 300 basis. Right. So it's gone from 5, and this is third tier, fourth tier markets. If you go into first tier market, so I'm in the middle of a sale. We're selling at a 4 cap. So I sold a deal a year ago at a 4 cap. The disparity is massive.
The inefficiency in your market that you're able to buy things probably at 7+ and still be able to sell things at 4, right?
Yeah, and to the inefficiencies in the operations. So when we go in and I'm buying something at 30, 40% occupied because you have an operator that's never even ran it, doesn't want to, right? That is hard in asset classes like multifamily that are extraordinarily efficient.
Well, and even those ones, because those ones still do pop up right now because you're having some kick the can people and the occupancy just goes down, 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 down. But even those ones, like they're still hitting the market and they're still catching. Like to your point, there's a lot of people who want to be buying properties right now. They just don't make sense. The numbers don't work. And so every single one of these properties, like there's a lot of eyes on it and a lot of people who are still bidding on these things. And all of those people, I guess this is probably me just complaining. All of those people are willing to underwrite outsized like cap rates, outsized rent growth, outside stuff, because you know what? They're probably right. If I'm going to be honest,
it probably will happen, but you don't know that. That's the problem. You don't know that.
We probably will see cap rates come down. We probably will see occupancies go up, and we probably will see rent growth above 3%. I actually believe those are likely scenarios. But at the same point, if I'm doing the underwriting, I can't go to my investors and say, hey, look, I decreased the cap rate. I know for the last 5 years, we've been increasing the cap rate on sale, every single one. Now, right now, we're not keeping it level. We're actually performing a decrease in cap rate. And not only that, we have a 3.5 rent growth instead of a 3 or a 2.5. And we also, on the top of that, we think occupancy is going to be 97 instead of 95. And do I think those things could happen? For sure. I'm looking at all the data. Like there are no A-class properties coming online.
No. That's like, so like you being a conservative underwriter, that's the difference between our market or our industries. I can do that and buy deals. As in, I can not project lower cap rates. I can not project rate increases, and I can still get deals that will give me that high yield because of two reasons. The competition in your industry is it's a lot, but also you have a system that supports it, right? In self-storage, try to go to a bank and tell a bank, no, bro, it's cool. It'll go from a 7 to a 4 cap. I promise. Like you're going to see rates that are going to go up a lot, even though they went down 15% over the last 2 years. Trust me, occupancy and rents will go up. Banks, they don't, because the replacement cost is not nearly a thing like it is in your industry. You have a large asset where banks can value it, investors can value it at like what its built cost. Self-storage, it's like net income. Like these are metal boxes. So the value can go from 4 million to 15 million just purely on.
It's still kind of the same with apartments, but I guess
there's more of a floor to that. Once you get to replacement cost, right? People are going to start buying.
Well, so I always use the example that you have two properties that have $1 million in NOI. One's 90% occupied, one's 50% occupied. Like I'll pay a 3 cap on the 50% occupied one.
100%.
Because the opportunity of buying that, but then I'll pay, a 5 cap or a 5.5 for the one that's 90%.
And that's what we're doing. We're buying deals that are
we might pay a negative cap rate. You might buy a property that's losing money if it's got value add.
Yeah, I bought one 4 months ago because of that exact reason, what you're saying.
Yeah, that's why we talk about the fact that going in cap rate is meaningless. We will buy a negative cap rate property if we can get a good deal. And to Kyle, I'm going to point out to you and make you feel a little bit better. I've been sitting in weekly meetings with you talking about the market and underwriting for 5 years now, 6 years now. And 5 years ago, 4 years ago, 3 years ago, you were saying the same thing, how annoying it was that all these people were outbidding us because they were willing to assume cap rates weren't going to expand as much. They were willing to assume ridiculous rent increase, whatever. Well, we're patting ourselves on the back today because we didn't get into the same issues that they did for several years. So yeah, we'll miss out on some opportunities by not being
quite a few acquisition fees too.
Yeah, but well, who cares? We protected our investors, and
I was being facetious, Jay. Jeez.
I know you were, but it pisses me off that there are investors out there, and there are a lot of them that honestly they would do that, go after the acquisition fees, and just hope that cap rates come down and hope that occupancies go up.
Well, they have to, and we ran into this problem like for 2 years. And for self-storage, because self-storage got slaughtered as we were looking at those numbers. We were like the worst performing one in 24, I think. We had we had market rates drop like 20%, right? And all of a sudden you have firms that they only can make money by doing deals. So what do you do in a market where deals are gone, lower than 2008? Like less deals were trading hands I think 224 than they were in, like 2008. What do you do in that scenario when you have staff, when you have all these people, right? And you built this big engine off doing deals and you're getting paid for those fees. All of a sudden you got to fire people. You're doing mass layoffs. And unfortunately, a lot of people, like Jay's saying, they choose to, we're just going to keep trying to do deals. We're going to do whatever we can to keep the money flowing in, not to get good returns. And that is a dangerous game. So by you guys, forfeiting it, being more conservative and keep a tight ship, you are placing reality as opposed to hopes and dreams. So a lot of people are doing deals saying, we believe, Kyle, like you said, all those things will happen. But what they really believe is, I need that fee. That's what they really believe. And unfortunately, there are a lot of people that are doing that.
It just sucks because I do believe those things will happen. But at the same time, like I can't underwrite it, right? Like I just can't. And so like, if you can find a deal that you can make pencil, even if it's like skinning in there, to your point, like I would be, if I just had a war chest, like I would be buying everything that I can, every single property that came on that had that value add, that had, even some distress, even those things, because there's some crazy stuff. I don't know if you're seeing this in your market. You're probably not seeing it as much because you said like the LTVs aren't as crazy as ours, but banks don't want to be running these properties, and banks are doing awful jobs of it. And they learned their lesson. They're not very good at it. We have a property that's like next door to one of our properties that the bank took over, and the place looks like a war zone now. It's killing us. But anyway, the point is that
the banks are terrible, but the banks are terrible at it, but they're pretty good at matching people. So they may want to take over a property, but they can go find another syndicator, another buyer, and say, hey, why don't you just take over the loan, or we'll take a 5% haircut on the loan, but hey, will you come in and buy it, AJ?
Thanks, Mauricio. That's where I was going with that. We've had quite a few properties that we've bid on. We didn't end up winning them, but the banks are willing to, because they're taking this over, or even if they're not taking over, they're about to take it over. And so they go to the current operator and be like, hey, like,
I'll flip it.
These are the terms that we would be willing to like take the quote unquote loss or whatever. And they're given like the terms in the loan that they'll give to the new operator, because you have to obviously stay with that lender. So they don't want to take a huge haircut, but they'll give you like a 95% LTV sometimes, or like up to like that includes like renovation budget and stuff. But like
they understand a lot more than they did in 2008, to your point though. The DCR measurement, they've got to work within that. So, they're looking at who's the operator, what can they do, but our conversation is just wildly different. So we had a conversation on a property where our DCR it doesn't work on the property. And the bank's literally like, your taxes went up 3x 1 year. And they're like, this is 100% because of taxes or whatnot. Nothing else has changed. And they're having conversations that I'm like, we never had these kind of conversations with banks before.
I think the 2008 issue was the banks didn't have an exit strategy. They thought a reasonable exit strategy is, we will take over this property and we will manage it until we find a buyer. And what they realized was banks aren't in the asset management business. And when they
do some shady stuff too.
If they take over a $50 million property for $40 million because the borrower can't can't make payments, well, that property is going to be 30 million by the time they get rid of it. And so they would have been better off working with the borrower to either cash
and they
for
screw
keys.
themselves because now you have comps. They're like, oh, we're going to take it lower in this market. And they're like, well, we have 100 million or 500 or a billion more of assets in that market. We just shot ourselves in the foot because we just literally, we're destroying our own market. And
it's fun. It's funny. You're actually better off right now the worse your property is, because the bank won't do anything. They'll try and help you. If you are like struggling to make your payments because of a rate cap or something like that, but there's equity in your property, then the bank's going to be all over you. They're going to be pushing you for a short sale. They're going to put like trying to figure out something for you to do, versus if you aren't making payments and they're looking at it and say, hey, we got a $70 million loan on this and this property's worth 60. They're going to be like, let's work something out. Let's try and get you paying. Let's extend this. Let's, you put a little bit more money in reserves. We'll lower your rate. They're willing to do a lot more than if it's a property that's actually not doing that well, but there's still equity in it.
The one of the things that we've seen with the banks too is I think they are on board with the rates being lower. I think their outlook is similar, and that changes, I think, how they act if they know in 6 months rates will be lower. And some ways good, in some ways good, right? Where they go, hey, we're on a better path and we might see something, but in other ways, not so good. And we've seen them drag out things that aren't, I'll say, beneficial to them, and no reasons at all for it. Like, there's no driving factor. They're just, we couldn't, like, it got weird. We're like, what is going on? Why are you dragging some of this stuff out? That's just, we didn't see, the market was more fluid. We didn't see banks doing these things 2-3 years ago, right? It was, nope, we do a deal, done. And there's a lot going on in the inside of these banks I think we don't know about. I think their balance sheets, what they're playing around with as they're getting low interest rates, as they're moving up on deals and the equity is changing. I think there's a lot of internal discussions at local banks, different credit unions, and even some of the national banks, but not nearly as much because they don't deal as much in commercial real estate, where they're looking more of portfolio management right now and saying, we're moving cards around. And I think people can be a little surprised at which side they end up on, right? Because they're motivated by things that aren't specific to that property.
But AJ, but is even if we talk about the JP Morgan prediction, and let's just say interest rates go down 100 basis point, like, does that really help, other than those on the margins, obviously, but does it really help? I mean, if you, again, going back to the multifamily, so this is maybe, Kyle, this is your area, but if you bought this property at 4%, or like a 4% interest or 4.25%, and you have a rate cap at 6%, like the interest rates has to go down to meet your stress test level, right? You stress tested where this kind of breaks even or whatever. Interest rates are way above that stress test. They would have to come down sufficiently to reach that stress case.
Well, there's two sides of it, right? Like the side you're talking about is people being able to like perform on their current held assets, and then there's the other side. I'm just
talking about getting to the DSR that
right.
That actually.
But then the other side of it is it like if it does come down significantly enough. First of all, it's not 1-to-1. So like if the 10-year treasury, like, it wasn't that long ago that the 10-year treasury was below 4 and staying 4, and we didn't think it was ever going to go above 4. If it comes down, and more, the other side of this is too, if banks start to get a little bit more comfortable with rates and where they are and them not running up and not doing anything crazy, like, we still have a lot of runway on spreads too, that's spread above the treasuries. So like, we could see, if we see rates come down for multifamily, if we see that 10-year treasury down, in the 4% range, and then banks all of a sudden are, they're bringing their spreads down, that, like, let's say we get it down to like 10-year treasury at 3.75 and the bank spreads are like 1.5, which we've seen at some points. That's low, but we've seen that. Then all of a sudden we're looking at 5.25 rates. Then like that's significant. And then all of a sudden we're seeing cap rates come down quite a bit. So if the cap rates come down quite a bit, even if those properties that are on those loans that, were really got hit, they took them at the peak of the market, at least they should be able to exit.
You're getting a more fluid market.
Right. They should be able to get out of it. The problem is you can't get out of these loans at all.
I think it's the second, like, I don't think, Kyle, I think it, for us and Will's others, it is actually the, it really second or third consequence. Lower rates will help move the housing market. And I think that is going to be beneficial. I mean, for our industry, if we got rates to come down 100 basis points, we already saw it last spring, Jay, when we saw that drop in the rates where it was like I don't even remember, that was May. Yeah, right. We had that sudden drop. Occupancy across our portfolio, boom, shut up. We were having like 150, 200 move-ins in a day. And then when the rates went back up, boop, completely done. And it was amazing how much pent-up demand there was, that even a small move in the markets immediately changed the housing market. And I think there's a lot of that going on, not just in the housing market. And whether you're multifamily or storage, moving is good. People moving from California to Texas is really good when you own multifamily in Texas, right? So when you have a market that's frozen, commercial real estate gets hit. And so we need movement and economic activity, not just in the form of cap rates, sell, but in the form of overall demand from people having different housing choices, lifestyle choices, and being able to actually extract on that. You get 100 basis point, we saw a movement. You get 200 basis point change. It's an entirely different world for us than we've been in for 2 years.
Fair enough. Well, any final thoughts, Mauricio, Jay? Or can we get a sneak in a top 10 here? I know Mauricio's been waiting.
Let me see if I can stall this out for another hour so we can avoid the top 10. Let me see what I can come up with.
One topic, and we still went over an hour. Good job, guys.
Yeah, this is at the root. I feel like there are some people who that they love to listen to the podcast just for some real world shit.
Oh, yeah, 100%. This was a good conversation.
What we're seeing. So it's always good to come back to that every once in a while. We'll touch on it. Hopefully in a month, it'll be even
So wait
better.
a second. Let's do quick predictions. How many rate cuts are we going to see before the end of the year?
Ooh.
Let's define what rate cut
is. Thank you.
We have 3 more meetings.
There's going to be 6 different rate cuts.
10 basis point each.
We could joke theoretically, like the Fed can call an emergency meeting at any time. So.
That's true. I'll start it off. I'm going to say we're going to see 50 basis points between.
That's why you wanted to start it off, because I feel like that's a general conservative consensus.
Well, JP Morgan says 100 basis points.
Yeah, I know, but
I said 75, whatever that was, 2 weeks ago, and I'm sticking with it.
75.
Mauricio?
I think it's going to be data dependent, depending on the data.
No, it's not.
So no, seriously. So I think
what's these days though. We're apparently getting news that the BLS might just stop reporting jobs. So what data are they depending on?
Yeah, I heard the BLS might be changing their technique. No, I think all kidding aside, I think the September 11th report will dictate. If the September 11th report shows more weakening, then I'm going to say 50 basis. I'm ruling out AJ. AJ's, I don't know what he's smoking today. 75, forget it. There's no way 75 basis point. But 50, if the September 11th comes bad, I could see 50. But if it's normal, I'm going to go.
We're talking about by the end of the year.
How many ways are we allowed to hedge this? Am I allowed to hedge each meeting and each jobs report, or we just get one like Mauricio? We're allowed to hedge one time.
Mine's going to be a moving average. I'm going to adjust it every time the Fed speaks.
Yes, exactly. Every
I'm going to edit this episode until I get it right.
Just because Mauricio said that AJ's smoking something by saying 75, I'm going to say 75 too then, just to jump on with AJ.
Well, we know you're smoking. It's just it's rare for AJ to be smoking, but for you, it's like a daily occurrence.
Hey, I'm going to be in Canada in like a week. I guess I can't make this joke anymore because most of the U.S. it's legal anyway now, but I was going to say in Canada, it's completely legal.
Yeah, me and you will be in Canada in a week.
I'm going to be in Canada in like next month or something. We're all
Wait,
going.
they're
to
gonna
Canada.
let you guys
We're going
in?
to Canada.
Jeez,
I'm sneaking, running across the border.
Oh, that's right.
aren't you bringing guns too?
Yeah.
That's got to be a tough one.
Have I told? No. Okay. I'm telling you the story. This is my favorite story about Canada.
You already told it on the podcast one time.
I don't care. I'm telling it again. I don't
Guns
care.
in the guns in the
I'm telling it
airport.
again. All right.
the
I
guns
wanted
in the guy at the airport. Where,
Everyone that listened to this podcast and heard it, you are going to sit and listen to this again.
All right, well, let's do a cheers and a drink while we're doing this. I'm drinking Woodford, by the way.
Diet Coke Solo Cup, baby.
Red blend from North Carolina.
All right. So I love Canada. Like
No, you don't.
I
don't.
do.
No, you don't.
Okay, listen. I love Western Canada. So, I love
Except
absolutely
Vancouver.
love
He
it.
doesn't love Vancouver.
I love Alberta.
So I go up there. I mean, almost once a year, but we go up there, and it was on a hunting trip with my son because he wanted to go hunting. I'm not a hunter, but I guess I am now because he wants to be. I go to the airport. They're crazy about guns. They kick you out of the airport. You got to go check in. You got to come back in. You're going through all the security stuff. And I'm in there and I asked the guy, we're down on the bottom. I'm like, do you think this is a little overkill? First of all, not a lot of this even makes sense. And let me tell you what, I got a speech. And that speech was how us Americans don't value things like gun. And Canadians, they understand how dangerous guns are and they take care of it and they got to be careful with it. This is a serious matter to Canadians, unlike Americans. So I'm like, okay, sorry, shouldn't have said anything. I got my big speech. We go and we head up to the Yukon. Okay. We get there. Guns aren't there. Nobody knows where our guns are. Can't find them. We have to leave the airport. So the following day, we're calling our guns and ammo are gone. So I'm like, maybe I can talk with somebody at the airport. We can't get anything. So I go to the airport, not in the security, out where they have like baggage. And then there's a huge walking area. In the middle of the airport is sitting on the floor, my guns and ammo sitting as people are walking by, just strolling through the airport. I look around, I walk over, I just grab my guns and ammo and walked out. And they were just sitting in the middle of the airport. I don't know how long they were there for.
You should have put a big sticker on it, like "This is a gun," and then maybe they would have taken better.
Oh, wait, no, you could tell it was in a gun bag.
I don't know, guns. I assume it was a rifle. That looks a lot like a hockey stick, and those are just left around everywhere in Canada. So.
Canadians don't steal stuff.
All right, sorry, I love that story.
All right. I got a little offbeat top 10 here, and it's just because it was something interesting that I found. I saw a random article about this. I don't even know how it's pronounced. Acela train, and they were really excited about it because it's now going to go up to 160 miles per hour, surpassing the current fleet of 10 miles per hour. And I thought to myself, holy 160 miles per hour, that's fast. But then they mentioned in the article how like we have very antiquated rail systems and how this is like nothing compared to the rest of the world. And I was like, 160 miles, that's not even fast. So I was like, what is the rest of the world doing? And so I went and looked it up, and I thought this would be interesting to talk about how fast the trains go in some of these other countries. So there's quite a few of them. They almost all use the same systems, but also I'll start with number 7, and it's a tie. 186 miles per hour in the United Kingdom, Germany, Italy, and China. One of the Chinese ones all go 186 miles per hour, which obviously it's faster 160, but it's not like, okay, like that much faster. Then we get to South Korea, 190 miles per hour. Then we get to Spain, 193 miles per hour. And then in Morocco and France, they have trains that go 199 miles per hour. And then, Japan's 199 miles per hour, but it's capable of reaching 217. They just dial it back. And then I'm not even going to want Fuyinghao, China, they have trains. Their trains go 217 miles per hour from place to place.
It doesn't really seem that much faster than 160.
But think about an hour trip, though. Like how much farther? Okay, I like taking the train to New York City, and like that trip takes an hour and a half to 2 hours depending on which train you take. And I know a lot of these trains go like New York to Washington. Like you would be cutting off hours to that trip by train. Like you could, if we had trains going from Philadelphia to New York at 217 miles per hour, that means it would like less than an hour to get from Philadelphia to New York City. And if you do that, like people would just live here in Philadelphia and every day commute to New York.
That's what they're doing in California. I mean, they've been, it's now 20 years they've been doing that train, and how many billions have they spent? I mean, there is no train, nor tracks, nor anything else, but they've been trying. So I think did they give up on that?
I still know. I know one guy who like our kids go to school together. He works in New York City, but he only has to go in the office 2 to 3 times a week. And so he takes the train 2 to 3 times a week in New York City. It takes him, an hour and 45 minutes. But like, imagine if that was 45 minutes. Like it would just break down all of these, especially these Northeast cities that are all like 3 hours apart. Like people would just live where it's cheap.
Well, think about the West. Our closest city is 7 hours away. That's the closest one to us. So, if you had a train that connected, literally you went from Seattle, Boise, Salt Lake, Denver, and then you could go to like Texas. I mean, the United States is the perfect landscape for that kind of stuff because it's huge. And if you connected metros, I mean, to the density problem, traffic in LA, like if you had a train that went downtown LA that could go up the coast to those other cities, you would disperse population. Like,
For reference, so that 160 is really fast compared to the next fastest. Jay should know this. What's the next fastest train in the U.S.? Oh, come on. It's all over. The Bright Line in Florida goes 125 miles per hour and just kills people every day.
It's nowhere near me, so I have no idea. I think that's the one that they're talking about extending.
It goes Orlando to Miami, so nowhere near you. Like, isn't Orlando like an hour from you?
Well, Orlando's 2 hours from me.
With all the stops, I'm better off just hopping on a horse and just galloping down.
By the way, when we say 2 hours, that's like a hour train ride at 160 miles an hour.
Anyway, you got you got any, what's it called, hypotheticals for us, Jay, to finish this off?
Here's one. How much would somebody have to pay you to be 10 years older immediately? Add 10 years to your life, but $1 billion.
Can you add? Can I also determine what kind of shape I'm can I be in like tip-top shape in 10 years older?
You're going to be in the same shape you're in now.
No, I'm talking about tip-top shape. I don't want to be in the same shape.
Do you guarantee that your spouse stays with you?
I know your spouse, Kyle. You can't guarantee that now. and my spouse is looking for an excuse. So
does your spouse stay the same age, or does your spouse also go 10 years with you?
Nope. She stays the same.
She stays the same age?
And she's going to be happy about it because she's going to inherit that money 10 years sooner.
We could joke about hypotheticals, but I guess like if you say put $1 billion in front of me for 10 years, I mean,
no, I wouldn't do it.
No,
dude, 10 years. That's
$100 million a year.
That's my freaking life. You know all the things I can do in 10 years?
Yeah, but you know how many... Wait, AJ, here's what you're missing. AJ, here's what you're missing. You know how many years of your life you can add when you have that much money with the technology that's going to exist, and that you're going to be able to live from one
That's the best argument I've heard, Mauricio.
Never given up 10 years of my kids.
That's a good point too.
But net, you're ahead, AJ. If you don't have that money, you're going to die at 100. With the money, you're going to die at 120.
I'm not missing their childhood for any
Could you
money.
strategically do it right when your kids are those like preteens, when they're going to like hate you anyway? Like,
AJ, you're not missing that. You're just 10 years older now. Your kids
you wake up tomorrow and you're 10 years older. Everything else is the same.
Oh.
But I go back to the Cody Sanchez thing where she says, like, take any billionaire in the world that is 60 years old, like they would switch lives with you.
No, it's the Warren Buffett. Like I wouldn't switch places with Warren Buffett for sure.
But you might switch places with the 60-year-old.
Dude, bring it on. I'm in.
Yeah, I don't know.
Mauricio, you haven't answered.
I'm in. It's a lock. It's a mortal lock. It's a mortal lock.
$1 billion, you do it?
Yep.
Mauricio, do you have 10 years?
I'd be
Snap.
gaming. I'm already ahead
Well,
of the game.
there's the funny thing. He's guaranteed another 10 years if he takes the
Yeah,
bet.
there you go.
Although I might wake up and then be dead. Like I'll wake up in 10 years and I'll be like, dead. Yeah. If you were going to die in the next 10 years, would you skip that event and just like, now you get a second life?
You're asking the hard questions.
These aren't like every scenario thought through hypotheticals, Mauricio. You're too critical of it. They're supposed to be just for
Does my
fun.
hair become whiter in 10 years or is it the same level of whiteness?
Will I have hair in 10 years? Wake up and I'm bald. I'm like,
So,
I
Jay,
don't
I'm
know that I
assuming
like
you're
this
doing
right
it.
now.
Are you doing it?
No, I'm too old. I'm too old. I might have done it 10 years ago. How about this? $1 billion,
It's easy for you to say looking back, but
$1 billion, but it rains every day, no matter where you are.
See, that's where that one I
you're
think
basically
about that
saying
one
the
more.
rest of your life's going to be miserable. So screw that.
Yeah, that one I'm very sensitive to crappy weather. Forget about rain. If you just told me it was going to be like really dark and depressing and cloudy.
Yeah, that just means either my wife would divorce me because she cannot handle. She gets seasonal depression anyway.
That's literally the reason I moved to Florida.
Sarasota never gets hit with hurricanes, right, Jay? That's when you were convincing us.
That's
to
not
move
seasonal depression. That's just like every other week for a couple months a year.
there. I'm never going to let you live that down, Jay. What was it, 2018, 19, where you're like, oh, you got to move to Sarasota. It never gets hit with hurricanes ever. I've done the math. There's this special thing that goes on in Sarasota that it never gets hit. And like it happened like twice in 2 years.
Fun fact: the first hurricane of the season is forming off of Africa right now. So
I heard.
So
I did hear
It's
that.
coming for you.
could be coming for me in a week.
Straight path, all those hurricanes. All right, plugs. AJ, what do you got?
YouTube channel. Alex works hard on it. It's doing a really good job. And they're training me better and better by the day. So
AJO, go check it out.
I think our podcast is out there too. If you want to look at the latest podcast between AJ Osborne and Mauricio Raul, to go to the YouTube channel.
that's right. Check it out.
Mauricio, you got anything else to plug than that?
No, I'm going to plug if you're a syndicator and you want to make sure you're doing things right and you want to do some consulting with me, go to coachingwithmauricio.com and we'll see if it's a fit, but I can make sure that you raise capital compliantly and not end up in jail.
Nice. Jay, you want to do your plug or you want me to plug?
No,
Or what do you want?
I'll do mine, but we're going to do it again when AJ gets back. He's gone for the next 2 weeks, but when he gets back, we're going to do a special episode. But I'm plugging my wife. So my wife is launching her new business tomorrow, which I guess is yesterday when this releases. And it's an upscale gifting company currently focused on cookies, and it's called Smooch Cookie. It's called Smooch, but smoochcookie.com. And
It's ridiculous. That peanut butter cup cookie. Oh my gosh. Like, oh my gosh.
You
It was
get a
so
visual
good.
of this. This is the box inside the. This is the third box. you get your box on your step, and that's a good looking box. And then you open that up, and there's another box, and then this is the third box, and it has a magnet on it. The thing seals with magnets.
It will hold paper. It's perfectly sized, 8.5 by 11, so you can put it on your bookshelf, and you can.
And there's a little like note in here too, and then like it's like special wrapping paper, and like look at all this thing. Like this is I have never received a gift for Christmas or my birthday in my life with as good a wrapping as this.
It's so good.
My wife is a design person and a gift person, and so people are going to think it's a cookie company. It's a gifting company. It just happens to be cookies, and the cookies I think are pretty good. She spent a year working on these recipes. Every cookie is like at least a half pound. That's crazy.
Well, here. Should I open it?
Sure. Which one's that? The red velvet?
I thought we were all going to eat one on the air. I thought that was going to be like our thing. Like, look at it. It's like the size of my face. Look at this.
My favorite is the cappuccino.
This red velvet's pretty good too.
Red velvet's good.
Oh, yeah. The
You
red
want the
velvet.
cappuccino? You could have my cappuccino one. I'm not a coffee person.
Oh,
I
The
skipped
red
that.
velvet one was good.
Red velvet one's good. My kids love the double brownie blast.
Mauricio's like,
Yeah,
I
my
haven't even
kids
opened
loved it
mine
too.
yet.
They just killed it.
One. Oh, so good.
Okay. I will be sending you guys another one. Don't open it. We will open it and enjoy it on the episode when AJ gets
I'm going
back.
to give you a new address.
Perfect.
Yeah.
I'm going to have to literally tell my family, though, that it's coming and they can't open it because the moment they see it, they're going to be like, rip it open and just be like, "Where's the cookies?"
Jay, can I make a request though? Can you not have it arrive? Like you had it arrive Friday, and then you expected 4 cookies to last
No, not gonna
until Tuesday. This has to arrive Monday or Tuesday. Like there's no. Like you realize how much willpower it took me for those cookies to sit there. And I was like, I can't open this thing. I when I say can't open this, I ate 2 of them, but I can't eat all of them because then you're going to be like, oh, let's everyone have a cookie. Be like, I don't have any cookies because you sent them to me on Friday, and you're expecting me to not to eat it 1 cookie a day.
That's not my fault. That's Jay's fault. So I don't feel bad at all because how could he expect that from me? They were gone.
Well, thank you. And if anybody is interested in sending a gift to anybody they love, smoochcookie.com. And for the next couple weeks.
Should we post our addresses too? Just in case.
And you can actually, if you want to send us gifts, send us gifts. Use coupon code forward to Smooch. Use coupon code forward, and you'll get free shipping for the rest of the month.
Hey, Jay, when was the last time you plugged your wife?
I just did.
I think that was the first time since the start of the podcast that he plugged his wife.
That's right.
That's how she likes it.
It's been like a year and a half. Like
that's about right.
He didn't even plug her on her birthday. Like that's how bad it is.
Her birthday's Christmas Day, so we don't do an episode that day. So.
Oh, okay. Or otherwise, you would have plugged her.
Absolutely.
Well, I don't mind plugging your wife. I'll plug her right now, and I'll plug her next time we do this. And I'm
as long as we're getting cookies.
Yeah. Hey, I'm an easy sell. I'll plug anyone for cookies. All right. Well, so I guess we have to say au revoir to AJ then.
That's right.
Are they French on that side of the country?
No, they're not. There's no French over there. They actually, most of them hate the French over there.
Hey, AJ, make sure you take some bear spray with you.
We will.
Take your boots so you can say a boot.
A boot? Like these boots?
Yeah, it's all a boot to boots.
New dude to boot.
Photocopy. Make sure you take a photocopy of your passport and have it somewhere safe when they, jump you and steal all your passports.
Are we gonna have someone fill in next week? Is that the plan?
Mauricio has somebody in mind. Good surprise.
Ooh, does he?
I do.
So you have to wait till next week.
All right. Well, I guess for everyone except AJ and then special guest, we will see you next Thursday.